Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Back with another video this morning. The market is actually closed. RIP Jimmy C, but I thought it'd be nice to do a video about a company I did a video on maybe a year ago. I thought it was a bit expensive at the time. The stock is down maybe 20, 30 bucks since then, so I thought it would be worth revisiting. Down about 16% in the past year. In the past 5 years, up only about 9%. This company does pay a dividend, has continued raising it. It's by no means a dead company, but there are some headwinds that they're facing in terms of their business growth, and that is leading to shrinking earnings in 2024, the expectations of continued shrinking earnings in 2025, and revenue growth really stalling. They really experienced a big boon during the pandemic. They were able to raise prices a bit more due to inflation, earnings growth benefited, etc. But now that's kind of moved in the other direction, and this stock really had a valuation that was very excessive here. We'll take a look at that in a second. And now that valuation is coming back down into kind of what it's normally traded in. This is not a growth stock. It traded like a growth stock here because they grew 2 years in a row in the 10 to 15% range, but now they're back into essentially 0 to 2% growth for the foreseeable future, and it's trading as such, probably as it should. So what is Hershey's? Again, they make chocolate, they make candy, they make salty snacks. They've kind of moved into that salty snack space more so in recent years with the acquisition of Homestyle Pretzels, Skinny Pop, etc. But at the end of the day, most people know them as a chocolate maker. In general, they don't make the best chocolate. For example, their Hershey milk chocolate bars have 11% cocoa. That's not really real chocolate. I think in Europe, it can't even be defined as chocolate. Kind of like the American cheese product. This is the American chocolate product. They do have some other stuff that actually has high cocoa content, obviously, and a bunch of other candies. So some of their products are really solid. My wife is a big fan of the Reese's peanut butter cups. I think that's one of the most popular candies in the world. So their brand portfolio is pretty solid, and they continue making acquisitions. After the last earnings, they acquired the candy brand Sour Strips, which is actually a small brand that was started by a YouTuber, I believe. So I don't know exactly a ton about it or how much they paid for it, but this is a brand that, obviously has the cash flow to continue paying a dividend, but also make acquisitions as they have in the past couple of years. So looking at their last earnings, the main negative here was a lowering of their outlook. The earnings themselves weren't too amazing, a decrease on the revenue side, a big decrease on the EPS side, down about 12.7% on EPS for a variety of reasons. But in general, there's some sales pressures, there's some volume pressures, and there is some cost of goods sold pressures that are going to continue to be a problem 25 and onward. So as we look at their lowered outlook, net sales growth down from a guidance of 2% to 0, earnings growth down from low negative single digits to mid to high negative single digits, and that's not a great thing. They also have some adjustments that they're making. They had some layoffs, some business realignment activities slash layoffs, and also some acquisition related activities that are going into that adjusted figure, which is slightly less than the reported EPS that they're giving. And overall, you can kind of see what's driving it. Salty snacks, volume down about 17%, down 15.5% on the revenue side. International not doing too well. And international is a small part of their business. This is very much a North American business, mostly in North America, i.e., United States and Canada. Internationally maybe makes up 10% of their revenue. So not a huge brand internationally, maybe because their chocolate only contains 11% of cocoa. But maybe that's a good thing given how expensive cocoa is. And we'll talk about that in a second. As you look at this, you kind of look at this and say, wow, negative 15.5% growth on salty snacks. That business is struggling. I wouldn't worry so much about that because what happened, they had a new EPR system put in Q4 2023. So due to that, they knew they weren't going to be able to produce as much in certain areas. So they overproduced in Q3 of 23. So their salty snacks division was up like 22% on a comparable basis in Q3 23. So now it's down 15.5% in Q3 24. So kind of just overproduced. Now they're underproducing because there's too much on the market. That should normalize on a go-forward basis. So the expectations are that you're not going to see these huge swings up and down on a go-forward basis as this new EPR system is implemented. So what's going on with the business? What's really causing the problem here? And why is the stock down as much? There's some worries about cocoa prices, and the cocoa prices have really shot through the roof. And this is a company that makes chocolate. They use cocoa powder, cocoa butter, other cocoa derivatives or whatever to make chocolate. Obviously, they don't only make chocolate, they make other stuff, but this is a good, significant part of their business. And cocoa has gone up from, 3,000 towards the middle part of 23 to 4,000 at the end of 23 to nearly 11,000 per ton right now. So their most significant input costs have tripled basically in the last 1 year or so, and that is a problem for them going into 25, because usually what happens is these companies hedge their costs in a way. So they might have hedged towards the latter part of 23, but they usually hedge for about a year and a half at most. So as you move into a year and a half since these prices have started to shoot up, 25 is going to be the time where their hedges kind of start to run out. It's impossible to tell exactly how much they hedged, but they've sort of talked about how their cost of goods are going to go up by, high single digits in 25. That's pretty excessive when their usual price raises in a non-inflation year are about 2%. That is going to lead to suppressed margins. That is why their expectations for 24 EPS are as low as they are. They're shrinking, and 25 is not going to get any better. So they're going to see, mid to high single digit shrinkage in EPS in 24, and then the expectations for 25 are probably going to be high to low teens. High single digits to low teens in EPS shrinkage. They haven't given 25 guidance yet, but that's kind of what I expect, and I think what most people are expecting in the analyst community. So as you look at the stock, again, 5-year performance only up 1% annually. This does pay about a 3% dividend. So again, maybe a 4% return in the last 5 years. Annually, maybe 7% annually in the last 10 years. Kind of reminds me of Nike. I did a video on Nike just a few days ago. Sort of a similar story. Really benefited during the pandemic from various reasons. Now is tanking, getting back to valuations that make sense. Speaking of valuation, I mean, look at this. So basically, historically, before the pandemic, this stock sort of traded in the 4 to 6% free cash flow yield range, sometimes a bit more, sometimes a bit higher, sometimes a bit lower. The peak here is 7%. Then, you saw a year or two of 10 to 15% growth, and suddenly this is a growth stock. Suddenly the stock is trading at a 1 to 2% free cash flow yield. Absolutely ridiculous. High 1%, low 2% free cash flow yield. Now that growth has kind of come down, the valuation is sort of resetting back to historical norms, 5 to 6%. And again, that is a pretty decent valuation when you think about what Hershey is. You kind of look at their financials. This is a company that's been pretty steady. You look at 2020, did not lose revenue during the pandemic. People still bought candy. People still bought chocolate. Their free cash flow was positive. Their net income was positive. You go back to 2008, 2009, growth here still happening even during the Great Recession. So this is kind of a company that people like because they are consistent, because they consistently make income, and they're not going to go out of business anytime soon. However, people are worried about what these cocoa prices, these high input costs mean for their earnings. And as you look at these estimates, you can kind of see that, hey, growth has certainly slowed down from these, high roaring 2% free cash flow yield days to 0% with expectations of kind of flat to 2 to 3% growth, kind of what they've seen historically. I mean, this has never been a teens grower. That was just kind of an aberration due to how high inflation was. Now it's sort of getting back to where it used to be, and where it used to be is trading in that 5, 6, 4% free cash flow yield range. Especially now that earnings for the first time in quite some time are shrinking because of these high input costs. You can kind of see expectations for net income being down about 7% in 24 and 25. Analysts expect net income to be down by about 13% or so because these cocoa costs are finally going to catch up to them. They're no longer hedging. They're not going to be able to just say, we're going to raise our prices by 9% because the price bumps they made in 21, 22, and 23 are already leading to volume shrinkage. So it's like, yeah, we're offsetting with price, but people are buying less and less of our candy, our chocolate, our salty snacks because there's a lot of other competition out there, cheaper prices. There's only so much you can raise your prices before you start losing business, before people move to the next other alternative. As the lower middle class, the middle class are still kind of struggling. Inflation is hitting pocketbooks, and people are spending less and less money on discretionary expenses. This is not a must-have. You can't just say, we need chocolate. You do need food. You don't need chocolate. So that's one thing to keep in mind as an investor. As we look at valuation here, again, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So historically, again, this is traded in that 6% range. On a lagging 12-month basis, it's at 4.7% right now. On a go forward, on a next 12-month basis, it's at 5.5% right now. But again, this number is sort of elevated based on some inventory stuff, et cetera. So I think the reality is that this is more realistic. It's sort of in that 4.7% range, which doesn't mean it's like expensive, but it also doesn't mean it's very cheap. So as I look at where I'm pricing this on a go forward basis, I probably would place something like Hershey in that 5% free cash flow yield range. I will share this spreadsheet in the link down below, in the description down below. Hit make a copy, file, make a copy. You can play around with it. So I have, again, 0% growth for 24, 2% growth in 25, and then 3% growth on a go forward basis. Margin shrinking in 25 because of cocoa prices starting to rise again in 26, 27, 28, but being still kind of lower than the historical top ends of like 17 to 18% because those cocoa prices being elevated for potentially an extended period of time. If they start to come down, this could be significant upside to a stock like this. You can make sure that these margins can get up to 17.5%. They do pay a dividend. They've raised that dividend at a decent clip in the last couple of years, 15% 2 years ago, 15% last year. I'm kind of trimming that back down to about 8%, but still right now getting about a 3.4% yield. If that continues, the 8% growth continues at today's prices, by 5 years from now, this is going to be a 4.6% yielder at today's prices with a $7.46 dividend in 2028, raising at 8% year over year. And they have the cash flow to do it. This is a free cash flow generative business. It's not going to die or anything like that. But I think the valuation does have to come down a little bit, as it has. So it certainly makes sense. They do have some stock buybacks, not a ton though. They could really benefit from a bit more of those, 300 million a year or so. So about 20% of their free cash flow going towards buybacks, kind of the norm in the last couple of years. And with a 5% free cash flow yield, you sort of get an expected return of about 8.7% from today's prices. Not too bad, when you think about Hershey, versus a treasury bond or something like that. Obviously not as safe as a treasury bond, but safer than a bunch of growth stocks that are out there trading at elevated valuations. So I can kind of see why people are interested in this stock. But again, is it a value trap? Is it something that's going to keep on dropping because of the uncertainty of cocoa prices, because of the uncertainty of where their free cash flow margin goes? If cocoa prices remain elevated for 5 years, again, this could be $129 fair value and expected return of about 6%. So as I put it down here, I have a target return of about 7%, which inclusive of dividends gets me closer to 10.3% or so. Gets me to a fair value of about $147. When I look at the historical ranges of 4 to 6%, kind of gets me to an expected return of about 5.7 to 12.6% at today's prices at $146, which is my fair value. Kind of get me to about 7.9 to 15%. That's kind of where it gets interesting to me. This is still a very good company. Obviously, some roadblocks ahead of it. There's potential for acquisition as well. They're going to make acquisitions. That's what they do. But also, Mondelez in December came out with some interest about acquiring Hershey. That's where the stock, if we look at the stock price here, kind of jumped up to $190 briefly. And when you look at Kellanova, for example, which was recently acquired by Mars, I think that was a 25x multiple to their free cash flow. If I look at their expected free cash flow for the 12 months and just simply apply a 25x multiple to that, that's a 21% boost to today's prices. That's one way you can look at it. What would be the fair value of a stock like this if it were bought out? Probably at least 20% higher than today, probably a bit higher because Hershey, I think, is a better brand than Kellanova and has better brands than Kellanova. So maybe even 28, 30 is what you would get for Hershey in a buyout offer. But I don't think Hershey is willing to sell. I think what you're doing here as an investor is you're sort of trying to get into Hershey at a valuation that historically makes sense, which is probably closer to 5 to 6% of their free cash flow yield. If you look at 5% of expected 2025 free cash flow, it's maybe 3% below today's price point. If you look at 6% of that free cash flow, it's maybe about 19% below today's price point. So in my mind, to me, this is getting interesting. It's not quite there yet. But if it keeps dropping a bit more, even though there's worries about cocoa, even though there's competitive pressures, even though I know their earnings are going to shrink in the next year, I feel like, if you can get it in the 145 range or maybe even lower, if there's still pressure, I think Q4 doesn't really matter. I think revenue growth there is going to be high single digits. EPS is probably going to grow versus a decent comparable quarter, but then 25 guidance is really what matters. And I think investors have to expect, revenue growth in the low single digits at best, and then EPS growth in the negatives, well in the negatives. Like if they release something that's -5, that would be a pleasant surprise. And I think the stock would go up. But if they release something in like -15 range, that would be a detriment to the stock price. So that's kind of where I'm sitting at with Hershey, sort of where I am with Nike. I mean, these are companies that like have these brand names, but they've just gotten overvalued. They have to come back to where they've historically traded because they are the companies that they've historically been, and or they have some struggles ahead of them. In the case of Nike, it's a lot of competition and revenue decreasing. In the case of Hershey, it's cost pressure with their biggest input costs going up quite a bit and staying elevated, and their hedges running out. So I think that's what you're going to see. You're expecting this to continue, but like I said, if cocoa prices stay elevated well into the latter part of this decade, this could be a stock that could fall quite a bit more from where it is today. But if cocoa prices suddenly reverse, if the crop is good, etc., if tree diseases and viruses and government pressures aren't bad as they have been, this could be, a stock that's valued very fairly at today's price. So for me, probably another 10%, and I would start a position probably. I kind of like this company. They're going to continue growing their dividend. I feel like this is a company that even if we have a recession, yes, the stock price will drop. You can kind of look at 2008 and what happened there. Let's go back to 2008. This was a $53 stock. In the bottoms of 2008, it was in the $36 range. So that's, what is that? Maybe 30% or so. So certainly, despite the fact that it didn't shrink, it just became a better value in 2008. I think this company probably wouldn't see a huge decrease in revenue during a recession or a decrease in net income. It would still be free cash flow generative. It could potentially buy back shares at a good price, but it would allow investors to obviously buy back at a better valuation because it would still drop by 20-30% from today's prices, or maybe even more, because that's just what happens in a big recession. So those are my thoughts on Disney. Again, as always, video is purely for informational, educational, and entertainment purposes only. It is not investment advice, but hope you enjoyed it. Let me know what you think about Hershey down below. Do you agree, disagree? Are you a buyer here? Are you not? Do you demand a bigger target return? If you want to play around with the spreadsheet, it's always in the link down below. Hit file, make a copy. Thanks for watching. Like, subscribe, all of that good stuff. Welcome to the new people that joined the channel in the last couple of weeks. Again, I will make more of these videos. And if you want me to cover any specific stock, leave a comment down below. And thanks for watching. Bye.